topics. Who are Rock USA? Who are CCCD? What can they do for us? What is a limited equity housing co-op? How does it work? This is very important for you folks because you need to know your responsibilities as well as your rights as a co-op member should we go down this model. We'll go over just that, resident rights and responsibilities as part number 3. Then we're going to stop the presentation, collect your questions. You'll come up to the microphone one at a time, just like we do in PAC meetings, form a line down the center row. We'll take each one as they come. Once those are over and we pick up the questions on Zoom, we'll come back and we'll very briefly just touch on financial implications of self-ownership. But that's really going to be a deferral until the next meeting, which you'll hear about. And then we'll go on and show you the process that we're doing, a high-level process that shows us how we get from here to there. And then finally, the announcements of the community meetings coming up on the 28th of February, as well as the critical PAC vote on March 6th. All right, our experts, Jody Byatt from Rock USA, flew out here from Chicago to be with us. Big round of applause there. Kim Coons, the Executive Director of CCCD, California Center for Cooperative Development. And Randy Keller, who's the real estate expert, will help us through all the negotiations on the pro formas, et cetera. So I'm going to turn it over to you folks. That might work, if not, just manually ask them.
Okay.
Excellent. Well, so happy to be here with all of you. My assumption that California is normally sunny is quickly evaporating. But no, it's great to be here. I come with a 25-year background in real estate finance and nonprofit management. And I've been at Rock USA for 2 years. Since the 80s, we've done nothing other than help residents buy their manufactured housing communities and as resident-owned cooperatives. And then in 1986, we started the national Rock USA and right now we're at 315 rocks nationwide. And we're working on you hopefully being our 3rd rock in California. So very excited. You have all the support of the 35 staff people at Rock USA. I'm here to symbolize that today. When we started to expand in the 80s, we grew through an affiliate model. And Kim Coons at California Center for Cooperative Development was kind enough to take the reins of the Rock model in California. And we provide training and support to her and her staff and support to her rocks. There's a lot happening at the national level, which will hopefully plug you in on later. There's an online training system. There's meetings and calls, and there's actually very advocacy campaigns state to state to strengthen the rights of people living in manufactured housing communities. So we are laser sharp focused on solving this problem of people living in manufactured homes but not owning the land underneath. And we're 100% about the limited equity housing cooperative model that we're here to talk about today. I'm going to turn it over to Kim, who, like I said, has taken the reins of the Rock model here in California.
Thanks. Just to talk a little bit about our nonprofit, the California Center for Cooperative Development. This is our team at our annual conference last year, and actually which was in San Jose. Just a little plug, this coming late May 31st and 1st, it will be in San Diego with a whole track for housing co-ops. And we serve all different kinds of co-ops. So we have serve worker co-ops. We help with startup of consumer food co-ops, agricultural co-ops, particularly smaller worker co-op farms. We work with childcare co-ops and the gamut of housing co-ops. And then we have a specific program where we work with manufactured home parks that we call Cali Rock. And we're not super consistent about highlighting the Cali Rock name, but we're trying to get there. So I want to talk a little bit more about how Rock and CCCD interact. We're an independent nonprofit, And we're part of a network of similar nonprofits across the United States. So all of the states that you see in blue are have a ROC affiliate, and each affiliate pretty much covers either the state they're in or a range of states surrounding the center. So we're part of ROC USA is also a nonprofit, and these blue states add up to about 21 states with about 316 resident-owned communities, and they represent more than 21,000 home sites. So we work together. ROC USA is really good about convening all of our centers to share stories, share information, and so forth. And as Jody suggested, they also have a robust resident program also. And so I just want to back up. Well, what is it about cooperatives? I have to do a little plug here. Sorry, you have to put up with me. So you're actually, all cooperatives are part of a international network of high-level cooperative organizations that meet periodically to discuss, well, what are the cooperative values that we stand for? What are the principles of cooperation? And you'll learn more about those later. But basically, this is the value statement from the International Cooperative Alliance, which we all adhere to, which is cooperatives are based on the values of self-help, self-responsibility, democracy, equality, equity, and solidarity. In the tradition of their founders, cooperative members believe in the ethical and values of honesty, openness, social responsibility, and caring for others. And ultimately, cooperatives are self-help organizations. And that's why some people all on the political spectrum think that co-ops represent them. We have very, very conservative producers that are members of very large agricultural co-ops. Absolutely, when we give a conference for them once a year, they're holding their I Heart Co-op signs. And we have the opposite side of the spectrum. So cooperatives aren't a political statement so much as they are a tool. And just to borrow on, in 2012 was declared by the United Nations as the International Year of Cooperatives. And actually, we're going to have another one of those in 2025. We're going to look at how we did. We made some goals and so forth. And this Ban Ki-moon was the general of the UN in 2012. And he says, cooperatives are a reminder that it's possible to pursue both economic viability and social responsibility. So I think it's always good just to remind why, as nonprofits, we do our work. This is what we believe in, and this is what drives us to help in development of cooperatives. So let's just move right into the resident ownership model, and hopefully I can cover a lot of your questions. Some of these slides I actually presented when we were online, so they might be a little bit of a repeat, but I tried to include some new ones as well. So in the resident-owned community, basically residents form a cooperative to purchase and operate the park and the grounds, and of course individually own their manufactured home. Each homeowner will purchase an equal ownership share of the manufactured home park. And these shares don't actually relate to a particular parcel. They relate to the entire development, which would be all the buildings and all the grounds. And you collectively own it, and that's represented with an equal share that you have in the cooperative. And then members, the park operates at cost, and members pay monthly site fee, lot fee, rent to cover mortgage and all of the operating expenses. And then the park is democratically governed on the basis of one vote per household. It doesn't matter if you have a double wide that's got 2 stories or whether you have a single wide, very small. It's democracy is by household. And then just a few highlights about this model in California. So California, we really are one of the few states in the nation that actually has statutes. We've had it since 1986 about limited equity housing cooperatives. And it's really a distinctive form of a nonprofit corporation. So what you would do first is you would incorporate as a nonprofit corporation. And I want to say that all cooperatives actually are in the nonprofit statute. It doesn't mean that even some of them are for profit. This is not the same as an IRS nonprofit, which has 501c3 status. That would be something, if you wish to, you could apply for. There's mixed results on whether or not you get that, that 501c3 status. And then the statute, our limited equity housing cooperative statute has a limit on the appreciation on equity that you can earn. And this would, again, be just on the park and so forth. And this is to maintain the affordability of the housing over time. So this is the distinct thing about a limited equity housing co-op is, you know, you get a good deal, the next person gets a good deal that comes in. So let's just take a little look at, well, what happens if you want to sell your share? What happens if you leave the cooperative? So if a member wants to sell, they're selling really both their share in the cooperative and their manufactured home. So, and they're separate. So any sale must be to a purchaser who is willing to be, who's going to be a resident and be a co-op member. So this is a little bit of a twist. When a residents first purchase the park, whatever you are grandfathered into whatever situation you currently have. So if you're currently a renter, you would stay a renter. If you are just a vacationer here, you can remain a vacationer. But after that, everyone needs to be a member of the cooperative. So when you sell your share, that person has to commit to be a member of the co-op, and people that are currently here can have a choice whether or not to be a member. And they have to, this needs to be their primary place of residence. And there's a reason for this. It's not just to enforce rules, but if you think about how you're going to vote and how your decisions are going to be formed, it's going to be very, very different if you are a renter of property than if you are an owner of the property. And if you are a full-time resident or if you are a vacationer, it's going to be very, very different. So we want to create the situation of equality and equality of perspective as well in terms of the cooperative. So again, here's a little note about the limited equity cap on the co-op share. That is only on the co-op. You sell your manufactured home for whatever the market will bear. There's no restriction on that. Members can sell their home, at market. It's just that their co-op share is permanently restricted. And ROC has a little bit different formula. In California, the limited equity housing co-op says if you have this model, and this covers stick-built homes, all different kinds of homes. If you have that model, the limit is 10% per year, which you can imagine that allows a bit of equity, especially in our state. However, in ROCs, they are zero equity. So whatever your share price is for your co-ownership of the park, that stays the same price when you sell it. And the other part of the statute is if you decide you don't want this to be a co-op anymore, or you want to sell it, or for whatever reason, maybe there's some financial things, whatever, the equity goes, if there's any equity that belongs, like people would get their share price back first, of course. And when people leave, they get their share price. It's not a membership fee that you lose. It's something that you get back. But if the park changes in any way, all of the proceeds, the park either needs to go to another limited equity housing co-op or another cooperative, or to a charitable nonprofit. And this is another protection, actually. In the 2008 housing crisis, co-ops did very, very well, particularly limited equity housing co-ops, because they couldn't refinance, they couldn't try to take equity out of the property. And another thing that I see a lot is we get a lot of calls in our office saying, oh yeah, I'm a realtor, I saw this property, I want to approach the residents, I want to purchase it from them, and we have a buyer. And the thing is, this is another protection for the limited equity housing co-op, because if you have a financial gain, you might be tempted to sell and really spoil that continual affordability. And a lot of people don't realize when they're approached, they think, oh God, $1,000 right now, just for my share, just to sell this out. But actually those people are put out onto the market where $100,000 won't even account for a down payment on a new home. So it's really not a good deal to try to sell anyway. So it's just a protection.
You try it
So
online.
why is it that Rock USA requires that all of the projects, even in states where they don't have a special statute, they need to be a limited equity housing cooperative? And it really is all about mission. It's to create affordable, stable communities. And we'll go in and we'll be reminding you of this throughout the remainder of the program. But basically, Rock Capital, affiliate of Rock USA, offers a loan of up to 120% of loan value. And that's really important, as I'll tell you about in just a minute. We want to maximize membership and minimize displacement. So in all of the Rock communities, it's not only zero interest, but there is a limit to how much you can charge for the shares. The share price needs to be between $100 and $1,000 per site. So again, the share price, other models, there are mutual housing models where your share price is basically your down payment. In a Rock, it's not a down payment. It is just part of the whole process. And that's why they offer these loans of up to 120% loan to value. And that's why they can have this share price that's really small. So the community then is resident focused. The decisions that you make are based on what you want as a community. And again, it's resident owned and all of the, it operates at cost, and that remains stable over time. So I just wanted to step back just a minute and talk about the different roles that we have in this model. And I'm going to start at the bottom, talk a little bit about Rock USA and why we became a member. Like I said before, we are an independent nonprofit that is part of the network. We have an agreement with Rock USA to use their systems to do a lot of different things. And the reason that we're a member of that network is because of the mission and because of the processes. So Rock USA is developed systems that make resident communities competitive in a purchase. So in your situation is not the same as we have in a lot of situations. A lot of times we're going in where residents just learned their park is up for sale and it's available on the open market. And a lot of investors are really like manufactured home parks. And where else can you get a bunch of people that have a higher stake than owning their land, owning their manufactured home on land they don't own? That's a big incentive. They can raise the rates as much as they want to because you're very vulnerable. So Rock USA is developed to make you as competitive as possible. And that's the goal. So that's why they do the high loan. The high loan is so that you can pay for all those upfront costs that you need to have when you purchase something, your due diligence, all of those kinds of things that Jody and Randy will talk about in just a minute. And Rock USA, I mean, the biggest thing is how do you get money to purchase your park, right? So the partner and division of Rock USA is Rock USA Capital, which is a CDFI, a community development nonprofit that loans money. They get their money from lots of different sources and have a lot of restrictions on that money as well. So Rock Capital is there understanding the model to fund this, because what I have in all different kinds of co-ops is people don't understand cooperatives. They think they are not a good investment. There's lots of different things. So having that money available with an entity that really knows the systems and so forth is a tremendous advantage to make you competitive in purchasing your community. Let me tell you something else about Rock USA, about Rock USA Capital and CCCD and our program Cali Rock, is that we have a high investment in making every single community that we work with work. And that is because, again, this is our mission, is to help residents. We want to help as many as we can become resident-owned communities. And what happens if one of those communities fails? You can imagine, it looks bad for all of them, right? So we really need to make sure that each community is as successful as possible. And so we are mutually invested in the success of every single community that we help. We also have obligations. CCCD is obligated to report financials and so forth to Rock Capital in a program called SharePoint, just a database, so they can monitor. So there's lots of monitoring that happens on the financials. And that's not to be invasive. It is really to support the success of the community. So then there are these other rules. So after the sale, you have a relationship with Rock USA through a number of programs that they have, but California Center for Cooperative Development through our Cali Rock program assigns the community a technical assistance provider that provides you with education, that helps you with your annual meeting, helps in any way that you can, and also does this reporting. So you'd have to sign something that says that all the financials, the management company or your management is going to be sharing those financials. We're going to be sharing that information with Rock Capital. So, and then the, oh, I'm not going to get the management company note. That's okay. So your community then makes decisions about how you want your community run. Your members are going to vote for a board of directors. Your members are going to vote for your bylaws, all your kinds of operating documents, and also you vote on your annual budget. So there's a lot of and committees, serving on committees. And then you will also elect a board of directors, and you would be deciding on your bylaws, what the size of your board is and so forth. And the board of directors then take care of all of the higher level decisions. We have to, this is a finicky project monitor. It just wants to do things a little bit at a time. So I'm going to turn it over to Jody and Randy right now.
Hi, I'm Randy Keller. I'm also a CCCD. I didn't get to introduce. I've been in the manufactured mobile home industry for 38 years now, working with parks and doing acquisitions and sales and that type of stuff. I am the acquisitions and advocacy manager of CCCD. So I'll be working with the acquisition part of this, with the city in this case, and working on getting a good deal for you guys, so that your rent doesn't go sky high. At least that's what we're going to try to do. And we work with performas, which is a document spreadsheet type thing, so that we can acquire the park at a reasonable rate and look at the infrastructure and the appraisals and the engineering to go forward and operate in a way that's affordable and equitable for you guys to exist.
Thank you, Randy. So Randy's going to be your on the ground lead, and I'm sorry, I like seeing all of you, so I'm going to be that giraffe. At 5'2", I'm a giraffe standing up. The typical purchase process is competing with other buyers to help the residents get under contract to purchase the park. In your case, you've been in negotiation with the city for years, and so we'll be carefully. We'll spend a lot of time with the PAC and with these folks. You have awesome resident leaders. So we'll spend tons of time with them, picking their brains for all the conversations that have happened to date. There's a long history here. We'll understand the 2007 bond issuance and how the city is viewing that today. We know about the developer having taken a run at the park last year, and we know that you fought them back. So we understand that your goal is to get the permanent stability of owning the land underneath your home. And you're in a fortunate situation where the land is owned by the city, and they do have social purpose to some extent in owning this land. So I know that a lot of you wonder about holding a long-term lease on the land instead of buying the land. And I just want to point out that the longer you put off this topic of buying the land, the harder it's going to get. Prices are not going down. The investor market that's so hot for manufactured housing communities is not going to dissipate. And so we really want to help you take a good, strong run at this today to get this park under contract. And so our normal purchase process would be negotiating directly with the seller or the owner. And actually, sometimes we go under contract for the residents because we've got the balance sheet and we've got the board. And but in your case, if we're lucky to get you under contract to purchase the park, you guys will be the group under contract to purchase the park. And I don't know how much the resident leaders want me to dwell on this right now, but you have an existing entity that's a mutual benefit corporation. we should pay for the park than what you want to pay for the park. And I'll use we a lot here because we really represent you in every way possible. Randy's and my job is to get you to that closing table to buy the park if that's where you want to be. So the pro forma that I'm going to talk about today is simply an example, but that's where Randy and I will be focusing with your resident leaders. And it has a couple parts. And so, and we try to keep these parts in sync. I'm going to back away from the numbers and talk about very first, the three parties that we try to keep in sync are the seller, the you guys, which will eventually be the Limited Equity Housing Corporation, I hope, and then the lender. And you can go to the market and try to get a loan from any bank that you want. But typically the co-op doesn't have any operating history. So it's hard to get a loan from a bank without any operating history. So we provide that service through Rock USA Capital. And like Kim said, they do lend up to 110% value. So in my sample numbers, I think these are sample numbers. I made them up because I don't want you to get any numbers in your head today. These are completely made up numbers. So I assumed an interest rate of 6.9%. Rock USA Capital prices its loans off of the 10-year treasury. And for those of you who like watching Bloomberg or Yahoo Finance, the 10-year treasury rate is flipping all over the place right now. And so if you close in the next 3 months, you might close at 6%, you might close at 7%. Maybe next year, I expect if we're successful in helping you buy the park, it could be later this year or next year, and rates might be calming down a little bit. So for today, I assume 6.9%. These are not your examples. Somebody else's park might be $20 million. And then this is how we build their acquisition budget. So this is the moment in time when you buy the park. We're providing up to 110% of that purchase price, which is then backed up by an appraisal. And so the banks need to see that the value is in the appraisal. And the reason that we're able to go up to 10% over the value with our loan is because we're a nonprofit. This is the only thing we do. So we have to make sure we put all these extra costs in your loan to cover you and to give you a good start. So there's the typical closing costs like title insurance. There's a fee for Rock USA Capital of 75 basis points. 0.75% is what they charge to initiate your loan. My friends Kim and Randy here want to get paid. And so there is a 1% fee on the closing for Cali Rock, and they pass a portion of that on to Rock USA. And then the lenders have legal fees, there's pre-development costs. And then the bottom part of this list is the things that the lender makes you kind of park for the future. And so they make you put money away for insurance, debt service, working capital, and then immediate improvements are the things that the engineer studies want us to fix in the park right away. And so we put that right in your acquisition loan so that you can start, hit the ground running with things fixed in the park. And if we're lucky, that number's only 125,000. If we're unlucky, the engineer wants us to do $1 million pipe replacement on day one. And then we're in a very different situation. So we plan on spending a lot of time with the engineering studies that have been done on this park and probably hire a new third-party engineer to take a new look at it all. And then we also hire specialists to dive into any issues that we see in the park. And those get covered with your pre-development loan that is part of the, so one of the things that's going to be hastening your starting of the cooperative entity is that in order for Rock USA Capital to give you, say, $55,000 to pay for another engineering study, is that 40% of owner-occupied homes need to have joined this new cooperative entity by the time that we give you the $55,000 and say, hey, let's hire those engineers and get a third opinion on what the park needs to, be really healthy and safe and stable going forward. An outcome of the engineering study will be a 10-year capital improvement budget. And that $125,000 in this example from the acquisition loan is the first payment toward that 10-year budget. So before I move on, I'm going to talk about the right-hand side of this slide. That's where the loan is modeled. And so you can see the acquisition loan in this example. Again, this is not your park, is 20.9 million. And so over on the right, you're borrowing 20.931 million. And then there's a resident chunk. And this is that cooperative share price that you guys will set, the minimum of $100 per household, maximum of $1,000 per household. And in here, it's modeled at $100 have been paid by 250 households. And what Rock USA Capital does is it sees that in your accounts, you keep that money, but then they credit you in your working capital reserve. So that's less money that you have to borrow because the Rock USA Capital really wants to see commitment by each and every one of you to resident ownership. And the commitment extends to putting that $100 into the cooperative membership, and that stays until you sell your house. If the co-op doesn't need to do any repairs on your site or whatever, as you move out, you get your $100 share price back. And then as whoever you've sold your house to needs to qualify for cooperative membership in the future. In this case, the debt service is $137,000 per month. And so we're going to keep that factor in mind if I ever make it to my next slide, which is the operating budget. And so you guys are really used to setting an operating budget. And I know that you currently manage your park. So this is exciting that you have a good history and knowledge of how to run your park and what it takes. And so we definitely would start with your current operating budget. This is just a made up one, but there's that key figure at the bottom, the $200,000 replacement reserve. That is a result of the engineering study. So when we spread out the needs of the park for 10 years, the engineer says, well, that backup generator is probably going to need replacing in year 5, and that's going to be $50,000. And we take all those costs, we spread them over 10 years, and then we figure out how much money is coming in from that acquisition loan, in this case, $125,000, and then how much has to come in from the operating budget every year, in this case, $200,000 to fund those 10 years of capital improvements. This is commonly called a replacement reserve, and it's an important part of operating the park. The other part that'll be new to you in having a loan is this part on the right side, which is labeled debt service. So in this example, the rents are $690 a month. And in co-op world, we call them site carrying charges or lot carrying charges because you own the park. You're not charging rent to yourselves. You're just contributing the carrying charge that the park needs to operate moving forward. And this example has 330 sites. The lender assumes that we're going to have some turnover in the park. So we always have to budget with 2% vacancy, which is kind of a bummer. In a place as beautiful as this, you probably don't have 2% vacancy. And that in this example, the effective gross income on an annual basis is 2.6 million. And then we have to manage the operating expenses to a level where the debt services coverage is covered, that $1.6 million on an annual basis. And then the surplus at the bottom has to be 10% higher than the rest of the expenses. And that's called a debt service coverage ratio of 1.1. And so the math is income minus expenses minus debt service equals the surplus divided by the gross income has to equal 1.1. And so every year, the lender's expecting you to generate $182,000 that you're not using. And then what happens is most communities vote to put most of that into their replacement reserves. And so you're stockpiling the money for your 10-year capital improvement budget, which in California, I understand reserve studies have to be done every 2 years. And so that 10-year capital improvement plan budget will be really fresh. every 2 years, an engineer will be updating those budgets, and you'll have a portion of your service of your surplus feeding the funding of those major capital improvements. I'm finally done talking about numbers, and I will take questions later.
I would like to add, first off, we on? Good. I would like to add first off that, yeah, we are used to DSCR.
Okay.
Yeah, we've had to, even though we're not the owners of the park, we act as the owners, and that we pay off the rent, the carrying charges on the park. We have been for 13 years, 23 years, whatever it is. And our DSCR has been 2.0 has been our requirement. So that's why we have such a nice reserve that hopefully we'll be keeping and going forward with. So yeah, we know about DSCR, and we're actually happy to have a 2.0. It really helps with bringing the capital financing up for us to go forward with what we need to do. So
That's good
if
practice.
it's better than 1.1, cool. I mean, we're fine with that.
Great. I think it's over to you, Kim, on the membership slide.
You want to try, Randy? See if it'll like you.
It hasn't
It
yet.
can. We need to, someone else want to try this advance, or just
We
like
need to go
different,
forward if we went
different
backwards.
fingers?
Yeah.
Come in and out of the slide.
The slide you have on, that one.
Next slide.
They've got it. They've got it. So I just wanted to just in summary, just talk about membership requirements and that topic. So basically, membership involves the ability to vote, or the right to vote, and the responsibility to vote on the annual budget. Members will elect directors, approve bylaws, approve community and rules, vote on major decisions. And I do want to say that, non-members will be the rights and responsibilities of non-members, should a person decide not to join the co-op, will be outlined in the bylaws. And so the members will decide how that happens. Sometimes there are certain privileges that a member gets that a non-member doesn't get. That will be decided when you make up your bylaws and your rules. Members also have the opportunity to serve on the board of directors and to serve on committees. And my experience is senior housing communities have a lot of committees. So there's a lot of involvement. And then the right to information and services also, and that's, as I was sharing, would be defined in the bylaws. And then if we can just go to the last, just kind of a summary of why we do co-ops. Oh, sorry about that. Just click on through. Basically, the park operates at cost. The resident ownership is going to stabilize these monthly housing expenses over the long term. That it really, what we find in a lot of the ROC communities, and this is actually documented in research studies, is manufactured home values actually go up in resident home owned communities because people have security, and they know that when they purchase the home, what things will be, and that does translate into getting a better price for your manufactured home. It also secures the value of the space and makes it so that you're not so subject and so vulnerable. It also protects the park from closure or being changed to another use. And again, no one can even force you to sell the park, because you have restrictions in the limited equity housing statute that say that you can't sell it unless you turn over the proceeds to a nonprofit entity. And so that's why we really like co-ops, and we like resident ownership, and we encourage residents to really look seriously at it. But I think one of the things that's really important, and Jody alluded to this, is this a co-op only moves forward if people vote to move forward. And throughout the process, there are voting stages where you can go right up to the end and say, no, we don't vote for it. And in every vote will be what your carrying charge will be. So there's a lot of democracy involved. And sometimes people get kind of worried, are we going to get that support? So basically you have to have at least 51% at the very end. But if the carrying charges go up a lot, you have to have 80%. So, and that's a requirement of the loan. So I have took a little tour of your wonderful, this is awesome. You just have such a wonderful site. And we've gotten to know a little bit of the leadership that you have here. And I can see by the participation here that you have just an awesome community and a beautiful surroundings and amenities.
Did you have anything?
Yeah, I just want to mention, this is a very unique property and it would really behoove you to try and purchase this and do the limited co-op. It's really to your benefit. It'll give you rent stabilization and it gives you self-governance, which is very important. So you all have a vote in the process. Very important.
Now comes the hard part. That is marshaling all of you good people to ask your questions and also those folks on Zoom. So this is the time. We'd like to ask you simply to come down the aisle, and if you get here, you'll see a black tape mark on the floor. Please stand behind that line and we'll get the mic adjusted for you and fire away. This is your opportunity, maybe your best opportunity to take advantage of the presence of these experts. So fire away. Zoom people, please hold on. We will pick you up at the end of our in-person audience questions.
Just be careful of the.
Hi, I'm Janet, and I would like to know if you can include solar throughout the whole park. So I would like it to be basically have water.
I'm just going to stop you there. Excuse me, that's not on topic. I'm sorry. We're going to stay on topic and it's about this LEHC model. It won't be
Yeah, I
about-
will just comment and say that, and this is a question that a lot of the co-ops that we're working with are, and actually just a little plug for our conference this year is we're going to have a whole panel on solar, but that's something that you all do. We can help you, but you would all do that.
Hi, I'm Pat Thompson and I was on Zoom. There's some people who came on later that are not muted. So could they mute, please? Because it's, thank you very much.
That was an easy one.
That was,
Hey.
that was easy.
Stand back, Michelle.
Michelle Rivers, 8 View Ridge Drive. Because we are a unique community and it's so beautiful, I wouldn't be at all surprised if there aren't folks out there who want to buy us, which was evident when Dan Moser came forth with his offer. So I got very insecure about that, and I'm glad we took care of that one, but they're probably, and Dan's probably still waiting in the wings. I heard that the city is wanting to get rid of us or not be our owners anymore. Is that correct?
It's not a question for these folks. It's out
Okay.
of scope for this meeting.
So my question is, if we do move forward with purchasing, which I hope we do, does the city of Novato have to put it out to the general public for sale, or can we have a private negotiation so it doesn't go to,
Also out of scope. I'm sorry. Not for these people. It's a question for the PAC board, but
okay,
not for these good people.
I will say that there's going to be a bill coming this year that you could support, which is a right to purchase initiative in either that's running through California right now. So you can look at that. And that would give you the first right. You might want to track that one.
Tell us more.
Yeah,
Okay,
that's a good,
thanks.
thank you.
Yeah, Maggie Siegfried on View Ridge. I hope this is on topic because it's kind of a major concern. Some folks are not able to get insurance, and I understand that many insurance companies are not renewing policies or writing new policies in the state of California. And is this something that a co-op model could help us with? Self-insurance or something like this? Thank you.
Jody might have something to add to this, but generally speaking, this is a problem for everyone in California right now, particularly in certain areas. And I know, I can't say being a co-op will change that, but we had a huge problem when a few years ago we passed in Mendocino and they couldn't get any insurance, but there is a state fund. And I'll tell you what, without Dianne Feinstein coming up to the table and saying, you got to help these people, we would not have sold that property on time. So I think as a cooperative, you have the opportunity to push your legislators a little bit more. I don't know if our senator would have come forward for one person, but for a community with 100 households, maybe a little bit more. And there's a state fund that the state basically, when you can't get insurance, you can go to the state fund and get insurance, but it's not easy.
Can I add to that, actually? One thing that an LEHC model can do for us is to help us reduce risk. We can work together much better as a community to reduce risk. So even if we can't get insurance, we can reduce our risks and the necessity for having insurance when we can't get it.
I'm Jim Grunwald. Thank you for a nice, clear demonstration, but I don't personally understand where Rock USA gets its funding.
Well, thank you for asking. The question is, how does Rock USA get its money? The Rock USA Capital Community Development Finance Institution is a subsidiary of Rock USA. And so when Rock USA Capital earns money on that loan initiation fee and on the interest rate spread long-term. So they might be borrowing at 4.5% and lending at 6.5%, and that keeps our lights on.
Okay. So no government institutions or?
Do we have government funding? On occasion, we're increasingly, you might have noticed that HUD finally noticed that manufactured housing is a source of affordable housing in this country. And we're poised to take advantage of that. Looking at federal funding going forward, there's actually a price fund that's going to offer grant money for infrastructure improvement, hopefully at ROCs nationwide. So we're working at the federal level to have more price fund dollars. But today, no, we don't get any government funding. We do a lot of spot searching. We have a state of Pennsylvania grant right now. We have a little bit of money from the state of California in connection with that MORE program, where a lot of money was available for a short period of time to buy manufactured housing communities. But so in general, we're 80% funded by our operations and 20% funded by grants.
Thank you.
Thank you.
Yeah, I want to say that wherever there is money, we will try to get it for you so that you can make your purchase as cheap as possible. So that's something that we're very active in. That is, your park actually came to us through referral through the MORE program. We had a contract with them to provide technical assistance there. And so we want to, I mean, absolutely, if there's government money available and you qualify, we're going to go for it.
And, correct me if I'm wrong, but at least I understand or hope I understand that if we get funding through Rock USA Capital, that there's a very good chance it can be the kind of funding that may not have a prepayment penalty, so that when we take out a loan, we can get things started with a loan and backfill later with grant funding if and when it becomes available. I don't know of another model where we can do that.
Yeah, often the structure is a first trustee loan at a certain interest rate from Rock, and then they may do a second for less amount at a different interest rate that can be paid off earlier that might match grant funds. So if we think we could get 4 million in grant, we'll do a second at 4 million. That way it's easy to pay off without refining the whole loan. Very good program, very good way to do things.
Howdy, I'm Kevin Mulvaney. I'm a resident here. On page 4 of your members' rights and response of the handout that we're given recently, it talks about an excerpt from pages 11 and 12 of the CCCD Cooperative Housing Toolbox. And it talks about members' rights. The last item is that the members have a right to dissolve, merge, or consolidate the cooperative or to form a joint venture with others. If the price of the sale of buying the park is not going to work for us, let's say they want 35 million or whatever it is, are you able to help us become a co-owner with the city? In other words, just say, we're not going to give you 30 million. Your budget is 6 million in the hole. We're going to give you 6 million. We want to be partners here, and we have certain conditions. You can't sell us. That reserve is for us, et cetera, et cetera. In other words, it's a different deal from whole ownership. If we feel it's like we simply can't afford to do this, would you actually, am I interpreting this correctly? Forming a joint venture that could be co-owners with the city if that's actually a more economical
Well, let me.
objective for us?
Yeah, let me first answer one thing. The Housing Toolbox is a publication that is published in Minneapolis, and it's just on our website. And so this particular thing doesn't really apply to limited equity housing co-ops. You can't, but you can't merge and consolidate. That would be really difficult. I'm not sure about that, but I would be very, very surprised if the city would want to do that, because there's nothing in it economically for the city except what you get in your payment. And I don't know. I mean, the goal would be to try to help you in whatever way we can to make it so that you can purchase the community. And the nice thing about the situation that you're in right now is that you have some flexibility. We're hoping that more will become an ongoing loan. And so it's funded completely by your fees that you pay every year as in your manufactured home. So hopefully that will be ongoing and you can qualify when that opens again.
I'm
So if
going to
the-
jump in with my financing hat on.
Go
Ann.
ahead, sure.
So what she said was absolutely right from a corporate structure standpoint. You can't share the limited equity housing corporation with someone else. So we would, if you decide that you want the city involved some way long-term, we can structure that more from a financial standpoint. For example, if the park was $35 million in your example, you might borrow 20 million and then keep the city in for 15 million at a lower payment rate. That would still be a financial relationship and not a stewardship relationship. If you want the city to remain a steward in some way, we would have to look at the bylaws and carve out a potential role for them in the bylaws, but that would need to be up to Kim and your lawyer.
But it's not impossible
It's not
if
impossible.
that's the best option down the line.
The state of California might tell us no, but we'd be as creative as we could be.
Oh, thank you very much.
Yeah.
Karen Mortensen, Fall Leaf Way. Am I at a good distance to make myself
Yes.
clear? This is better? Okay. Now, I understand what you're saying is that we would have a cooperative in which each household in terms of voting and privileges is equal. Now, we know that some of these lots are better than others, bigger or other things. So that's my first question is, if I assume that with the equal votes goes equal rental per slot, knowing that some are better than others, but let's say that's also equal. My question becomes this. There's a big range of income in this park. And somewhere, I'm wondering where all the advantages of the various loans and programs that we're looking for, are they going to reduce the whole cost of the park so that each household benefits equally? Or are we dealing with something where
low-income people pay less per month than higher-income people. And if that were the case, you know, who's in charge of deciding how much each family would pay?
Well, I'll start that and then I'll let Jody and Randy fill in. First, in terms of the cost for the carrying charges, that you determine that. It's very, very common, especially at first, for prices of carrying charges to be very, very diverse among each household. And so whatever the carrying charges are going to be decided by you and your board and that kind of thing. In terms of there's nothing that says that the price that everyone pays needs to be the same. And there's nothing that says that you can have any kind of program for lower income people. The problem with one challenge with recognizing differences of income is, and your community has, I mean, you've got a high median income in this county. So you can make a lot of money that looks like a lot of money for from the outside and be low income. Your park has a high number of low income residents. So we want to look at that in a couple of different ways. One is that having a self-generated program within the park can be challenging because it may mean a person that's at median income, which is not necessarily that much, is subsidizing, paying more for another household. You can do that, but sometimes it's hard. And actually in Mendocino, they did just that. Some people decided that they would pay more, but they paid it into a special fund. And so one of the things, and there's creative ways of doing this. There's a lot of different ways to create a fund so that internally there's subsidy going for people that are low income. And you could borrow more and put money into that fund. You could get it from another outside organization and put into that fund. One of the things that a negotiation when we helped Mendocino, it's another senior community, very, very similar to yours. And when they were able to negotiate in the purchase for the seller to put some money aside to help with, they had a huge increase in the price that they had to pay for the park was quite expensive. And so they were going to have a huge increase. And so they did some creative things to make sure that that increase came gradually and that they created a fund for the most low income people. And what we ended up with, they thought initially they could have an outside foundation monitor those funds. And in the end, they ended up with a fiscal sponsorship agreement with our nonprofit, which we do with a lot of different kinds of co-ops. And so we hold the money for those subsidies, but they have they make all the decisions on who gets it. There's a committee that's actually made up of majority people that are not even living in the community. And so they're able to maintain confidentiality and be able to subsidize the carrying charges for those residents.
The answer is yes. There's a lot of different ways that the community can establish different carrying charges based on a family's situation. One example is on nicer lots, you could vote to charge $50 extra a month for a nicer lot. We do have that in San Diego, where some people have a view of the golf course and some people don't. A different option is you can work together to create a resident aid policy, where you decide which house, at what level of income or lack thereof are you going to support each other? And could it be informal and voluntary, like Kim said, where some people raised their hands and said, we'll pay $1,700 a month instead of $1,200 a month in Mendocino. Those are different numbers. Or it could be formal. Our community in San Diego they created a resident aid policy and put together an application process where community members that want some help with rent can submit confidential information and be qualified for up to $400 a month in rent subsidy. So it's another situation where we can get creative and we offer options and you guys determine the path.
May I just clarify the question, which is, there were two parts. One of them you answered very well in terms of how the various options for differential affordability. The other one was how much, remember the first one was for the whole as a whole, when we get the big fundraising grants, do they go to the park, which gets distributed equally?
There's no grant that's gonna give you money.
Or, I mean, the benefit, in other words, if you get a grant that drops the price of the park, that's a kind of equal benefit to all the members. Is that correct?
Well, that would be defined by the grant, to be honest. It depends on what the grant funds. So grant, that's not democratic necessarily. That's gonna probably be governed by the grant parameters.
Thank you.
That's true. The More program, would have been acquisition funding that would have brought the cost down for everyone. That's a Minnesotan word.
Rotten.
But there are other grant programs that are individual. So again, like Kim said, is defined by the grant source.
And they're both kinds.
Yep, there's both kinds.
Really good question.
Little
Tom
closer,
Whedon.
little closer, Tom. Just a touch closer. Yeah, there you go.
Tom Whedon.
Still don't hear me.
Oh. Tom Whedon.
Okay.
A little bit more clarification on Rock USA Capital. Right now, the interest rates are rather high. If you could walk us through how we would, in the future, refinance that to a lower interest rate, that might be helpful. And also, a little bit more explanation on what Rock USA does as far as their loan term. How long is the term of the mortgage usually? And does Rock USA Capital keep that paper for the whole term? Do they sell it midterm?
Let's stop there and let them answer those. And if you
wanna take
have an
that?
additional one, we'll.
Okay. I got a couple more.
Okay. Yeah. So the first part of your question, the loan is a 10-year loan based on a 30-year amortization. It's renewable through Rock. And can it be refied because the interest rate went down? Yes, we can do that, but we need to do that in such a way that it's cost effective. So if the interest rate only goes down a half a point, it makes no sense. So it needs to go down a 2 or 3 basis points to get into the cost of the refi. But yes, it's possible.
And when we do blend our money with the money of other banks and other CDFIs, and that's usually determined at the outset. So we, Randy mentioned earlier, you might have a first mortgage loan and a second mortgage loan so that the second mortgage loan could be easy to pay off without a prepayment penalty as you whittle away your debt. We'd probably have 2 or 3 banks with us in the first mortgage, and then often we're by ourselves in the second mortgage because that's the part of the loan that goes up to the 110% value that other banks don't want to be exposed like that. But we don't sell the loan afterwards. It's all, the sandwich is made at the beginning.
Tom, you can be on the committee with the sharp pencils.
You have a high degree of ethics in your co-op statement. Just want to make sure you realize that we do discriminate here. We are an over 55 community, so we're age discrimination, just to. make
We're okay
sure.
with
It
that.
does,
Yeah.
the
you'll-
la-
you'll
the
live
la-
with
the last form of housing discrimination left in the US, by the way.
that.
Yeah. it is.
But once we do form the LEHC and the co-op, how does the Brown Act affect that organization?
You're not bound by the Brown Act. You get another thing that's equally, it's just difficult in other ways, which is called Davis-Sterling. And Davis-Sterling is, governs all common properties. If you're a condo, any kind of, development where you don't jointly own things together, you're going to be governed by Davis-Sterling. It's a consumer protection initiative, but it can be very, very frustrating sometimes. And I'll just give you an example. One of the things, when you have a vote, when you have board meetings, they have to be open to everyone. You can have closed sessions, executive sessions. Davis Sterling has very specific ways that you can do your voting. You have to vote by ballot, and it has to be double enveloped. The counting of the votes has to be public, and there's lots of,
No voting by proxy.
oh yeah, no voting by proxy,
Yeah.
but that's pretty much standard in a co-op.
Yeah.
So.
Thank you, Tom. We'll pick your other questions up at the end. Thank you.
My name is Paul Abbott. I live in the park 23 or something. I am one of those rare people who was living in the park before I was 55, so it's not just 55 plus. I was taking care of my 90-year-old mother when she died, and so I got to stay, even though I was only 52. I have two not related points. I don't know if it's feasible under the federal Section 8 program for people to get help on a mobile home that they own, but the person who was here up before was talking about the differences in income and so on. Just a possibility that you guys and everybody in the PAC might consider. I have a good deal of experience in the affordable housing business. I was the manager.
Paul, excuse me, just let's get right to your question for these good people,
Yeah.
because we have to get to the.
I
people
just
on
wanted to
Zoom.
say that the Section 8 program helps a lot of people, and it also is ridden with a lot of corruption.
Thank you.
Now, the stuff they sent us a couple of days ago, 10 pages, had a ownership voting system, which was one vote per parcel or per household. And I remember when we were talking about trying to get this place bought 24 years ago, one of the sticking points that some residents were concerned about was that, well, I've got a triple wide, why don't I get more votes? And I wondered how you came up with that program that, one vote per household. Many households have two people, many households have only one person. Some households may have three people and so on. How did you come up with that as the fairest way
It's
of
actually a
doing it?
fundamental of all cooperatives, which is.
I'm sorry?
Vote. It's not based. It's legislated in the LEHC, I think. I'm actually not 100% sure. But it is also just the way that cooperatives, it's not, your vote is not tied to the economic contribution like it would be in many stocks that you own.
Yeah, I got that, but
So
we're talking about one
It is
vote
just
per
standard,
household.
yeah, because remember the
household-
values, remember the cooperative values, it's about equality and equity. And so it's about that's just the way they always operate. So it's not really an
I've been-
idea, it's
I
not
don't-
based on anything except for the values of cooperative
It's
and
not- it's
legislation.
tied
No,
into
I'm
the
not
state-
talking about property value. I'm talking about the number of people.
I
in the
know, it's the
household.
same, it's the same.
How many rent?
So do you have any experience previously
Paul?
with other ways of assigning the voting?
Oh, it's
No, because it's not
legislated.
a
It's part of the
cooperative.
co-op. So it's just built in, hard baked into the co-op is what they're saying, and that's not negotiable.
How many rent bills do you get every month?
No, let's
Yeah.
move on.
No,
Let's
never
move on.
mind.
Thank you.
I'm gonna say, I think one of the parts of this question, thank you, Paul, was about participation. And so we do make room for the voices of all the members of the household. And so you can have as many members of the household as you want at the meetings. Different members of the household can be on committees. And so that's definitely one way of making an impact if there's more than one person in the household. And then when it comes down to voting, you have one vote per house, simply because the house is the unit that matters in this equation.
Yeah, it's
Um,
occupying this space.
That's a
One vote
confined
per
space, one vote per space. As you think about this issue, you can think about, I like seeing different members of the household being able to vote. But some cooperatives say no, that if you have two people, that Joanne is the voting member and Mary is not the voting member. And so those are things to be defined down the road.
Thank you.
Name is Judy.
A little closer. Closer, closer, closer. There you go. Can't hear you, Judy.
Okay, thank you. Okay, start over. My name is Judy Perdon Park, and I have been in the community for 5 years. Previously, I was in a Davis Sterling Act community for 24 years, of which 20 years I served on the board. And I do not have a question for you, but I have a support for the entire community. I am quite familiar with this program and the financial aspects specifically, because I was treasurer multiple times in those 20+ years. I would like to encourage this community to really look at this closely, carefully, but I strongly support it. It is an excellent way to own your own place, manage your own place, be your own boss, and take care of your property for perpetuity. Thank you.
Thank you.
Martina Cockert, 13 Marine View Drive. When I moved here 11 years ago, I participated in everything I possibly could participate in, including meetings of Marin County supervisors. And one thing came to my attention, that at the end of some meetings, it was said, there is still this grant money on the table, go and apply for it. And apparently communities had not applied for grant money, that just because, and for this, I want to thank all of you. We are community, we are brothers and sisters, but each single person has their bias and there are subgroups. But at this point, I want to mention that many of you have stood the path, continuously working for the community, spending their time, the time I don't have, because I work a lot for a relatively low pay if you cut it down to the hour. So on the other hand, I'm very vulnerable because the engineering insights that were available fell short sometimes, and therefore the results fell short. So that's what I have to stick up with for myself. However, what was said was, whenever there is money, we will try to get it for you. That sounds fantastic. The next thing what was said was, if you qualify, and I understand that this is us as community, all of us. And that leads me to my question. What makes us qualify for funding? And what do you exactly mean when you say, whenever there is money, we will try to get it for you? And how do we make that accountable? How do I, as an individual, know when there is money that we qualify for? And if you have the time to do that for us, because we are not the only clients you have, and I don't know how many additional employees you can hire,
Okay,
as your business will snowball.
Let's let them answer.
Yeah,
the
let me qualify. I meant at purchase. At purchase will help you get funding. And then after that will help you, but you would probably have to initiate it. And then
All of-
grants,
Yeah,
yeah.
all of you have done an income survey or hopefully have filled it out. That's what helps us with this process the most. Get that turned into us. I think we still have 60 or so to go, maybe from this.
And you need to put don't
Yeah.
fill it out if you're not going to include the income.
Income,
That's
yeah.
that's why it's
Yeah.
called an income
'Cause that-
survey.
That's what helps us with the grants is, are we very low or low income or medium? And that tells us that, and we can in turn apply for more in the other grant programs based on those income surveys.
She asked us how we'd be accountable for that over time. There's very few places to look for this kind of money. And so in the purchase process, we are accountable for looking under every rock. She mentioned Marin County. We will talk to them. We know what's going on at the state level. And so hold us accountable to that.
100% success rate says that you're accountable.
Yes.
Hi, my name is Masood.
Back just a bit, back just a
Yeah.
touch. A little more, back.
Yep, okay.
One more, yeah, there you go.
Can you hear me now?
Yeah, good,
Okay.
good, perfect.
I have a question regarding the individual homes property taxes after the conversion. Right now, some of us pay just a nominal registration fee. If your home is newer, you pay more, but it's order of magnitude $800 to $1,000 a year. So it's taxed completely differently from a condo or a stick home. Does this change our status?
No, it'll remain the
as far-
same.
Okay.
Yeah. Yeah.
That's significant. I mean, that would
Yeah.
make a huge difference.
Yeah, the homes remain yours. In addition, you're joining a co-op, separate entity from the home.
Okay, but just because we became a co-op, we're not like.
Yeah,
gonna be
we're not
taxed like a
absorbing your
condo
house.
or
Yeah, your house is
a
not
high-rise
becoming
or
part of the co-op. You are.
Perfect. Okay, thank you.
Hi, my name is Kamala Allen. I just have a few questions. One is, in terms of assessments, I understand you said that initially, we'd have an engineering report, which would determine what the assessments would then would be covered by the basic, oh, sure, the assessment with, the assessments for the engineering, report, whatever it is, what we need to rectify would be covered by the loan, right? But going forward, if there was additional, things that needed to be done with our structure, would we be on the hook for that as residents, basically? Want to take that?
And if something catastrophic occurs, that's maybe not covered under your insurance.
Yeah.
You have a bad water main break that causes a pothole to China or something. Yes, you would need to address that. Now, through ROC and the way we set things up, we have some reserve capital account with, depending on what the engineers say about the property of a few $100,000. And so we have pretty good protection there, but your board will vote to spend this money if necessary. So you still have a voice in what occurs here. So the main thing is you still have the self-governance and the voting on that.
Okay.
But if it happens, it happens. You will have to address it. Someone's not going to run and pay for it unless for some reason it may be a city thing. Maybe the city on their side of
Messed
the
up.
water main had an issue.
Somehow messed up or something on that.
And one more comment, because we've got a lot of people to get to.
Okay, sure.
Yeah.
Is the contract binding with CCCD in terms of, what if something happens and we want to change in some way? How does that work?
My understanding is you can change that. If
Okay.
you do something wrong and you don't like us anymore, but you would have to get ROC's permission, and whoever helped you would have to be, because they have your loan. It's going to be part of your loan documents. Your loan, you're going to have an agreement. You'll have to have an agreement with us that you will cooperate with us in providing you that technical assistance, that you're open to providing the information, like I was saying, in terms of the reporting and that kind of thing. Technically, yes, you can change who you have, but it would have to be approved by ROC USA.
Okay, thank you.
Thank you.
Hi, thanks for being here and thanks for your clarity. It's been great. I got three quick ones. One, some of us are really interested in establishing an emergency fund for people who have their roofs blown off or their carports destroyed. Would that be something that could be handled and managed by ROC CCD? Okay, whoever wants it. Thank you. Also, you have a 10-year loan based on a 30-year amortization. it can be refinanced. Once it's paid off, who's the title holder? Are you the title holder through all that? Does the title reverse to us?
The community is the title holder of the land. And then the lender has a lien on that
Just the
title.
lien, so it's typical as it is for others. And the other, last question real quick is, does the formation of an LEHC, I've been pointing Q down everywhere. I guess that's even more inclusive. Does it allow us to, does it preclude us from forming a community facilities district and getting Melrose funding? Do you know that financing, Melrose? No.
Yeah.
I do
Okay.
know Melrose, but I don't think you'd qualify anyway. I don't know. It's usually at initial development, I think.
But just having a LEHC
Yeah.
means that is our
I mean,
alpha and omega.
Yeah, the Miller is very common in condos, but
Yes.
that's not what this is.
Thank you.
Yeah.
Hi, I'm Carol Joy. Thank you so much. I don't really know how to say this. I was trying to rehearse, but I was interested in what everyone else was saying. We have had a problem over the years with enforcement of our rules. In fact, we have not been able to get the city to even look at our proposed changes in rules, which are many, many years in arrears. Our management company has a very difficult time with enforcement of the slightest thing. My concern, and I'll admit it's because I'm on the PAC board and intend to be involved as we go on in whatever way. My concern is about enforcement. If there are only a certain number of people who are in the co-op and then there are some who aren't, and I read in some document, oh, the people who aren't in the co-op don't use the facilities. Who's going to stand at the pool and say, I'm sorry, you're not a member, you can't use the pool? That's not going to work. And so what my question is, what is your experience with enforcement of rules?
I mean, your management right now, I'm imagining maybe it has to report to the city. But you hire the management company, you supervise the management company. And so theoretically, whatever you want enforced will be enforced. That said, I'm just going to tell you, it's hard to get a management company that you feel euphoric about. So I'm just gonna say that up front. And it's really, really hard. I mean, it's hard for a management company too. You know, they have their issues, but you know, for the most part, you're making the rules, you're supervising the management, you hire them, the contract is with you, the community.
Yeah, you're going to form a rules committee. You're going to review your rules as part of this process and come up with a set of rules that will be reviewed by an attorney and that are legal, of course. And that enforcement will be through the board to the management company and then off to the resident. So again, that's something you guys manage and vote. I mean, if you're not happy with how your board works, vote in a new board, you know, on the annual election. So you do have that kind of control.
Hi, thank you all for your time. 2 questions. I had called the More people and they said they're no longer taking applications and they're oversubscribed. And they said to me they would know in June if they were going to be refunded. Do you happen to have any inside information about their funding?
We're trying to get that information too, but I will say we're all citizens of the state and we can voice our opinion. And so I would just encourage you to encourage them to make the More program open. And I will say that they've had a big change in leadership with the program, and the leadership are we were dealing with the previous MPROP. It was very, very difficult. They wondered why so many people that applied for the MPROP loans were so dumb that they could not get through it. Honestly, they thought that it was all the people applying, and they were wrong, of course. And so now we have good leadership. I think they wanted it to be oversubscribed so they could show how much of a demand there is for this money. So at least the leadership
And so I think that.
Well, we as a
really-
community could reach out and put our voice out to who? Because then.
HUD, I mean,
HUD.
HCD.
Okay.
And your
Okay.
State rep.
Mhm.
Okay, and the other question is, you said every 2 years a capital improvement plan would be
Updated.
updated. So who does that? We do that? You do that?
It's actually 3 years and it's a reserve study. And,
Okay.
you hire an independent person to do your reserve study. And usually you'd hopefully find somebody that you like because it will be cheaper when you have the same person doing it.
Okay. Okay, thank you.
Thank you, sir.
Hi, my name is Charlotte Weiser. My question has to do with the fact that we're in Marin, land prices are very, very high in Marin. So I'm assuming the city is not going to sell us at a very cheap rate. And the space rents, what we're calling space rents right now, could go up quite high depending on how much money we have to borrow. Personally, I have been looking at the CLT, the California Land Trust option, and someone mentioned to me that there might, or sometimes LEHC does a hybrid with CLT. Is that true? And if so, do you have any experience of it and how that affects the pricing?
I have a lot of
for
experience
residents?
with it with stick-built homes.
Mhm.
And what I would say is usually if you want to be an LHC on a CLT, I would do it if there's a reason for it. It's
Mhm.
not going to be any cheaper for you. It's actually going to be more expensive.
Oh, really?
You still won't own the land. And what you do when you have a CLT, I used to be in affordable housing, and
Mhm.
affordable housing takes a lot. It costs a lot because you have to do a lot of monitoring and everything like that. You're going to have to pay the CLT plus whatever other expenses you have. So I would really look closely about why you would want to do a CLT. I think it would be more expensive for you, honestly.
Really? Because
with less governance, because
Mhm.
if a CLT is going to have parameters on that
Oh,
land and
right,
what they do, so you do
right.
not have a direct voice. And CLTs, I think there's a lot of situations where they are awesome. But if you can own it yourself, go for it, because there's no reason to do a CLT. They don't have any more money than you do. I know because I work with a whole bunch of them. They're doing the same thing. They're trying to find funding for their stuff.
Well, one of the points is that I believe there's no property taxes if you go with CLT. And would our park be liable for the mortgage that CLT takes out?
Well, let me tell you about a CLT. The CLT is the land underneath all these buildings. You would
right.
own all these buildings, so you would pay taxes on all of these buildings. So even if the CLT doesn't pay taxes on the land that everything is built on, it's going to cost you more because they have to operate. You're going to they need to pay for their operating funds as a nonprofit. And
Mhm.
so I would really look closely at it. I don't think that you're going to find that it will get you what you want.
Okay.
Thank you.
And I like CLTs. It's not anything against CLTs.
And I would assume the insurance would be higher too, because they would be also insured.
Yeah, they need to be insured separately from you.
Again, Michelle, once we pay off this loan, do we get any support from ROC? Or is it over then, our relationship? Once we've paid off and we're carrying the title?
I imagine that you're always probably going to have a loan because you probably would refinance that in 10 years and then you would have it. I'll also say that our nonprofit is dedicated to helping co-ops. We have contracts with a lot of housing co-ops where I do trainings and we do trainings all the time. So, there's no reason to believe that, in 10 years, if you still like us, that we'll go away and you'll never have a relationship with us.
Another way you'll have the long-term support is you'll all become members of the Rock Association as individuals, and that never ends. no matter who finances you, no matter when you don't have financing, as long as you're a limited equity housing cooperative with bylaws that are approved by ROC USA, because you meet the model, you're part of the ROC Association, and so you can tap into those monthly phone calls, monthly trainings with the rest of the national community.
Thank you.
I have the same concern that Carol Joy brought up about the status of members versus not, and how you differentiate. And I know that it gets put in the bylaws. Yet I'm a little concerned about the vibe and how having two different classes of residents affects that vibe. Because the vibe has been beautiful. And I want to see that change. I'm actually come back and I know what it was when I lived here just 3 months ago. So I have a question. Have you ever found a mechanism where you can make it financially advantageous for people to be a member versus not be a member, for example, like a mandatory?
Let's let them pick that up right there. That's a great question. Let's let them answer it, okay?
So I'll start, and then I think Jody wants to chime in too. You decide on what the difference is between members and non-members. And I will say, at first, oftentimes when you first purchase the park, there's a financial incentive to not be a member. I would just be honest about that because of funding that. But over time, that will change, and there will be a lot very strong incentives because your loan is going to stay the same, but prices are going to raise, and the prices for the increases for non-members will go up because they've been paying less for a long time. So they're going to continue to increase at a higher rate. But I think the vibe is really, really an important thing that you bring up, because the vibe is what brings you together. You all benefit from being a member. Anyone, it's open membership. This is a cooperative principle, it's open membership. So anybody can join. Anybody can join at any time. So at first, maybe some people would say no and then not join. But I would say that for the most part, there are very few people that don't become members.
So I would just suggest that just enable to show people that exactly in the long term is actually advantage.
We'll get there. Thank you. We have a lot to do in our upcoming meetings and thank you.
Joy said what she said.
Thanks.
The other thing I feel is I understand it sounds like you have a financial model and you plug in the appraisal of what you get from the engineers into long term. And I'm assuming you get look at the budget and you talk to Matt, you look to the budget again long term. So you ensure that the park would be financially viable under our ownership. I'm assuming that's what you do. So at these various votes, do we see, for example, an estimate of what the rent would be, an estimate of what this 0-100 to 1,000, just some estimates to give people a feeling.
You're going to see the whole performa, the entire performa.
Yeah, these will occur once we know what we're going to purchase the property for from the city, what the engineer and appraisal reports come up with. When we have those numbers, we put that out there. That'll be voted on. Yeah, of course. Yeah.
Thank you, David.
I have a question.
Yeah.
Oh, well, actually, two things here. My understanding is that the membership fee can be paid over a period of time if someone cannot afford it upfront, because we want everybody to be able to become a member, so that is negotiable. And then the other thing that I'd love you to discuss is something about your leadership training. We need to have pipelines to help create leaders to run this community in the future, because we're all aging and we need people to get involved and step up. So how does that work with what you're offering us?
Jody, did you
On
want to
the-
respond more on the
Yeah,
other
on the
question?
membership fee, it's 25% needs to be paid to join. And the other 75 can be done later.
Okay.
And then
Great. Well, there's two ways that you get leadership training. One is through, well, three ways really. One is through Rock USA, through the programs that Jody was suggesting. The other one is that we have ongoing trainings. I was just at this, I know I keep mentioning it, but I was just at the Mendocino Park doing a reading and understanding financial statements training that was open to everybody. There were people in the room like here and on Zoom. And so those happen as well. There are also opportunities within your community. You know, you may have people within your community that have skills that they can share and do workshops too.
I want to go back to the financial question. I'm sorry, but it's such a key point. That previous question was, when will we know about the cost of buying the park and the rents? That's going to be an iterative process over time. The more you find out, the closer we get to knowing that number. And so we'll start out with a range. And there will always be a vote if the rent's going to go higher than you've previously given us permission. So today we know that you want to pay X. That would be our goal for the negotiation with the city. If we can't get X, then we come back to you and we analyze what grants are out there. Would the city want to be in a second mortgage position with a lower interest rate to bring your borrowing costs down? And then we get to the engineering, which could jack your costs up, depending on what the engineering study says about immediate improvements. So we ask for your patience on those financial numbers a very long time, but we're as transparent as we can be with those numbers, and the control lies with you on what you're ultimately willing to pay. And as Randy mentioned earlier, if at the final moment when the lenders know their pricing and the rent needs to be more than a 30% increase, then 80% of you have to approve that vote, which is much higher than our normal threshold is 50% needs to approve the final vote to purchase. One more detail, the final vote to purchase for us includes 4 pieces of information: the maximum loan amount, the monthly carrying charge or rent, the 10-year capital improvement budget, and the 1-year operating budget. So you'll have those in any amount of detail you want when you make your final decision.
Hi, my name is John Feld. I want to know, perhaps you can tell us how long this process actually takes. It said in one of the documents, 150 days. Is that typical? Can it go on for 7 years? Can it happen in, we heard in Mendocino, it happened in hours practically. So can you give us a feel of how long this potentially might take?
Sure, the real estate timeline is different than the cooperative development timeline. You guys control the cooperative development timeline. That's the fabulous chart with triangles and squares and circles that your board have put together. That's the cooperative development process. That can be 90 days to 120 days. You guys have the novelty of taking your time because you really want to carefully think through these questions and educate yourselves. And I so respect that. Then the real estate timeline is most often dictated by the seller. So depending on the city's readiness to enter into a purchase agreement with you, a typical commercial real estate closing timeline is the 90 to 120 days that you saw on the chart. But we've also had the process take 2 years in Fresno. And so we'll have to see. We'll really have to see.
Thank you. I think I see folks here coming around for the second time.
It's a very important question.
I know, but the people on Zoom probably have very important questions too, Kevin. I'm going to ask you just to hold it off. And we'll need to move to the Zoom people so they have a chance to ask their questions, and we'll come back for second questions through. I'm sorry.
All right.
Thank you. John, are you able to tee up the Zoom folks?
Totally, yeah.
Maybe.
Ellen, Jane, Ellen, Jane, you need to turn on your microphone.
I did.
Okay, good. All right. Go ahead, Ellen, Jane.
Okay, I still don't understand why we have to buy the park. I'm a 20-year resident.
Let's just take your own break.
I hear an echo, but.
I'm sorry, Ellen. Yeah, it's not, your question
Yeah.
is not relevant. I'm sorry.
What?
You have a question specifically for our experts here on the co-op formation, the process, et cetera, all the material they've covered.
Well, it's
Okay,
about
no one
time.
else on Zoom, then we'll come back and pick up Kevin and Martina. And go ahead and stand in line and we'll come back in here for questions.
Well, that wasn't too painful for me. Wow. On page 6 of this handout that we received, where it talks about the ROC, the ROC bylaw highlights section 3, I believe. It's on page 6. It's the second item, priority given to lower income families. My understanding, and I might be wrong about this, people come in here with money and then slowly go broke. They don't come in here, I might be mistaken. You can't get in here unless you've got money to buy a place. So the question I had is the 30 days notice after intent to sell, you have to give priority to lower income individuals and families. And what I wanted to ask is, we need money in this park. We need people to, when they come in, to replace their home if they're buying a piece of junk, or to remodel, and it keeps the park refreshed and looking good. Have you noticed with your experience that there's been any tendency for the parks that use your services for the quality of the park to deteriorate? Or if it's like, no, if it's a nicely maintained park, the houses tend to stay. Well, I mean, if 10 years from now, this place is a wreck because nobody has any money, that's not good for the park. Or do you find it's like, that's not really a problem?
I don't think it's a problem, honestly, because the rules and so forth are created by you. Everyone has a stake in the community and wants it to be nice.
Yeah.
I do not notice that. And I think all of the research, Rock does research all the time, and that doesn't show that either.
And the individual buying the home needs to qualify for the park, much like they do now, like they qualify for the rent. So they do need to be income qualified.
They have to have enough funds to actually
Exactly.
function.
Exactly.
Okay, I just wanted to ask.
Yeah.
Thank you very much.
And that's the way it is right now, actually, and yet we still have a lot of low income people here, so everybody has to qualify even right now.
Initially.
Yes.
I'm concerned about the leadership pipeline. And I'm wondering if you've ever had experience with parks changing the age, like here we are with 55 limit, does it go up to 50 perhaps, so we can encourage younger folks to come in here and get involved with the community? Have you ever seen age limits change on a park?
No, I think the most active residents are seniors. Honestly, and very high skilled diversity.
But you could set up
Well,
your
and
own
that-
rules about it.
And that would, yes, and that would take a vote of the community.
Right.
So more than likely, you guys are not going to vote yourselves out of the seniors.
That would be in our bylaws.
We have a question from Miriam Dross. Miriam, please go ahead. Unmute yourself.
Yeah. Okay, I have two questions.
Go ahead.
Number one is, so everyone will then pay the same amount of rent? Is that what will happen? Can you
No.
hear me?
It can if you want it to. No, there's nothing that says that you have to. You will
Because
decide.
we were originally set up so that the rents were frozen when we got the very first loans. And the second question is, right now we pay possessory tax. So how will that change? Then we pay a property tax?
The
We pay
co-op, I don't
possessory
know.
tax
Yeah.
because the city owns us now. So we
That
pay it
will-
for them. But then if
Okay.
we own the park, does that mean that then it reverts to a property tax?
Yes. I don't know about the former, but you will pay property taxes, but the basis for that tax will be on whatever the value was when the city got it. It will not be reassessed.
Oh, thank you.
Thank you.
Yeah.
Janine?
I do know that we are looking at the possibility of via a nonprofit getting an exemption from the county for property taxes. And I don't know, related to that question, if you have any experience with how successful LEHCs usually are in getting that kind of
Not
an
very,
exemption.
not very. So there's two things. One is the 501c3 says that is an IRS. That has to do with your income taxes, right? And then the second one is something called a welfare exemption that you would get from the county. And that is going to be, you might be able to get part of it. I just want to make a little pitch that's not very popular. None of us like paying taxes, but do we like nice roads? Do we like nice schools for our kids? Do we like amenities and like parks and so forth? That is what our property taxes pay for. So I think it's really good to think broadly about that.
I have a question, if I could. We're all getting older, and we have talked about the need for a pipeline into our leadership, not only on our governing board, but our committees. What about you folks? What's your pipeline? Do you have staff coming up behind you, because you won't be in your positions forever, and we have a
Hey.
long-term relationship here.
Yeah, you saw a picture of the staff at CCCD. They're quite a bit younger than me.
Bunch of kids.
And I assume that you will be bringing these people along and
That's
integrating them into.
We're on a succession plan in my nonprofit.
Okay, that's great. Thank you.
We have a question from Joseph. Joe, unmute yourself and ask your question.
Can you hear me?
Yes.
Yes, my question is relative to the last statement in regards to the ownership of the land. When we're reassessed, is everyone going to be paid an equal amount, where in reality you have different values per the particular position of the unit? And two, if you have an assessment based on the ownership based on the income potential of the individuals, are you going to have to pay more than the people that actually are able to pay and compensate the county for the property taxes?
You know, it's going to be your property taxes, just like your insurance, just like maintenance and so forth, will become an operating expense, and you decide how that's going to be paid for, basically. And usually it's going to come out of your operating budget. In terms of the rents, like I said, you're deciding how those are determined. We're not deciding that for you.
Quickly, a follow-up question then. If we're doing that, and that I believe is prior to the establishment of the board, how can we determine, and is it up to us in the bylaws to determine how that spread or liability is going to be assessed for in each individual spot?
Well, you're going to vote on the bylaws, you're going to vote on the operating rules, and that's where those will be your auction. Also, I think that the community votes on your occupancy agreement, that's where that would be as well.
So just to make sure that I understand that before we elect board members, that they understand that there are bylaws that are governed by the ROC that dictate who makes the rules and what those regulations are.
Yeah, members vote on bylaws, any bylaw changes, vote on the operating rules, and I believe the occupancy agreement. There are policies that the board can make, and they could be like the use of the community room. You don't want that in your bylaws or any of these other documents. Those kinds of rules will be made by the board or committee or on advisement from committees and so forth.
Any other questions then?
None online.
Okay, let's, thank you. That was fabulous.
Oh, we got one more.
Okay, one more, and then we'll wrap and move on to the rest of the slideshow. Thank you.
Well, it's changing all the time. Ray, have you got a question?
Yes, I do. My name is Ray Schneider, and I know this meeting is devoted to LEHC, but are we going to also go through have meetings like this that go through other forms of ownership?
Yeah, I'll answer that. Next week's meeting, we are going to talk about financial implications as best we can. And we'll also talk about other models. So today is not the time to ask that. Yes, your question was fine, right? Because the answer is yes, we'll do it at another meeting.
Okay, this will be, you'll start this on March 6th at the PAC meeting?
No, it'll be February 28th. You'll see it if you stay online. You'll see the slide that shows the next meeting.
Okay.
Thank you. All right, let's move on. John, you have the next slide. Can we get the slide deck back, please? Okay, thank you.
Okay, financial implications. Now, as Alan just mentioned, that we're actually going to be covering those in a little better detail next week. And because the financial implications are, first of all, they're complex and they change quite a bit depending upon the model. So we have some information along those lines, but I can tell you right now that we have not gone into the depth of other models as we have on this one. And basically the reason is that we don't have to go into depth to see whether something is going to work for us or not. For example, if you wanted to buy say an e-car, electronic car, and you can look at a Chevy Volt. It doesn't take you long to realize that a Chevy Volt is going to cost you less than a Tesla. So, you don't have to do an entire analysis or get a bid or a quotation or look through your loans or anything like that. You already know what that is. So that's sort of what we did here. So we could see that what worked is an LEHC. The others really work far less or not at all. But at any rate, we'll go through that and we'll explain why and when and where next. That's a week from today.
What time?
On the 28th. Is that going to be the same time? Did we decide that? I think it's going to be another 2 o'clock meeting.
Okay, next slide. And can I have my mic, please? Okay, are you ready for an eye test? So this is an extremely high level overview of our process that was relatively accurate maybe last week. It changes. I think this is number 12 or 13 of these iterations. By the way, all of you who are taking pictures, the slide deck is going to be posted on our website. So you'll see that. So you don't have to do that. So I just wanted to point out a couple of things here. This that I'm pointing out here, the PAC board approval on the top line, that's what we did 2 weeks ago. Basically, the PAC was saying, go forward. All this other work here was work that our committee did over the last 5-6 months or so. Well, 4 months. And you can see the headings. I'm not diving in here. Then we had this review of the bylaws and the articles of incorporation, et cetera. Here we are at the first community meeting. That big first purple box here. We're going to have another community meeting next week, as we said. And then we have a PAC vote. And that vote is simply a vote to go on. Are you going to go on with this process or not? And all we need really, and as you'll see here in a minute, is a quorum. We need to have a quorum of the community, and then we need to have a majority of those present to say, yes, continue on. Go ahead and start the formation here. We'll have draft articles of incorporation, et cetera. We'll need to get some approvals along the way from legal. Finally, we'll file articles of incorporation, and they'll need to be approved by the state. And at that point, we have this next vote, and this is when the members of the co-op will vote, and we'll need a 51%, as I recall, a 51% vote to approve the empowerment resolution. And that empowers the board of directors to move forward on 7 key things, including getting the pre-development loan, et cetera, et cetera. It goes on and on there. We have all these purple boxes are sort of sub-projects, membership enrollment and that sort of thing, and fee structures. And this is a vote for the pre-development. And you heard Kim mention a minute ago that we need to have a good majority of our member co-ops approving that. And then we go on down here to this pre-development loan development. And we have these 2 parallel projects that you heard about, sub-projects. One is the real estate sub-project. The other is the co-op development sub-project. At some point, we'll get to an agreement with the city with an LOI, the letter of intent, between the PAC board and the city around a sale. Then we have a final purchase agreement. We still have work to do after that, having to do with signing the governance over from the board, the current board, over to the nonprofit board. Budget projections, financing, a big member vote here. We're going to have to add another box to handle that voting on the bylaws and the those other 2 items that came up. But here we have an election of the new board, and finally the final documentation around and the putting together of the capital improvements agreements, funding, et cetera, et cetera. And this is where we need 60 to 80% of the co-op members to accept, to agree to the funding. In other words, this is now what it's going to cost. We know what it's going to cost at this point. And 60 to 80%. If the rents go, or the rents have to go high because the costs are high, we need that 80% threshold, as Jody pointed out. And then we have a purchase complete, and we start operating as an LEHC. So this is our goal. Expect this to change a lot more as we go, as we find out more. But that's where we are now. Next slide, please.
I should say, Ellen, that the changes have been getting more subtle instead of major.
Yeah, true. Okay, so we have a critical vote coming up on the 6th, and this is where a quorum of the community must be present for that vote, present either here or online, and a majority of those people present must vote to continue on. As I said, 10% here. That's how the vote will go on the 6th. We have a question, but I'm going to ask you to hold it, Lisa, and bring it up in a minute. And let's go on to the next slide. By the way, the quorum is established by the current PAC board rules. This is our current operating rules here in the park. A quorum of the meeting is 10%. Jay, is that correct? Yes, that is correct. Okay. I think we went to buy 2. Did we go? Yeah, that's it. Okay, good. All right, next slide, last slide here. Where are you going to, next slide. Where you're going to find this slide deck is going to be on our Marin Valley website under the ownership options section. This is under resources. Anila, is that correct? Resources, and then yeah, it's on the right-hand side. Okay, right. Thank you. On the right-hand page, you'll find it. Just go there. And the slide deck will be there, as well as this handout. Both of those things will be posted. You've heard that some of the things in the handout might have been superseded by the material we've heard today, but it's pretty close. All right. Next slide. That's us, the ROD committee. Thank you. Thank you. And I just want to thank Jody, Kim, and Randy for making the trip here and being so gracious with your time. We're not under contract with these people, so we really appreciate you being here. I think you've done an awful lot here to answer our community questions. Fabulous approach with us and working with us, and we just trust that'll continue. Any closing comments, John?
Oh, well, yeah, one more thing I would like to mention is that we had a huge lever to begin with on the ROD committee, and that was Michelle Rodriguez and Todd Rogers.
Stand up, please, Michelle and Todd, please stand up. Michelle and Todd, please stand up.
Here,
Raise
here.
your hands, thank you. Yeah,
Here, Michelle.
thank you.
One other comment. Can
And
I get a
Dave?
mic? There was a question about how all this started, and I do think if anyone wants to express some thanks, they could also express them to Judy Lane. She sent me an email on July 8th as we were in the throes of the whole city selling process, and it just had one URL in it. It said www.calirock.org, and that's what led me to these guys. So thanks, Judy Lane.
Lisa, you have a question. Please come forward and speak to the mic.
You must get recorded.
Lisa Jackler, just really quickly, for those of us who cannot attend these very important votes, either here or by Zoom, how may we be counted?
I think our pact we do not allow proxy, correct? No, we do not, so.
Thank you. So if I'm working and I can't make it, that's too bad, huh?
I'll ask you to take that to Jay Shelfer.
Thank you.
Ellen, I think I can answer that right now, and that is the PAC does accept proxy, but the LEHC will not.
Well,
That first vote
a
is-
ballot is different from a proxy.
Yeah.
So you should, usually the communities are voting with a ballot box with a period of time in which to.
Not that first one, I think. That first one is just show of hands, man.
No, well, that is the Rock, but not in California necessarily.
All right, then we need to
So-
regroup on that, so.
Since I'm standing up, Anita Flantz, there are numerous people in this park who work 8 to 5 because we are an over 55 community, so that has to be accommodated.
Right. So I just, one of the things, lifetime. One of the things that was subtly said here is that at the beginning, there's going to be two organizations on. Yeah, sure. On March 6th, we're still operating under PAC bylaws. So the voting and the decisions on the earlier diamonds that Jay showed, most of those are going to be under PAC bylaws. At some point, there will be a transition, at which point we'll be operating under whatever the bylaws we vote on as the LEHC bylaws. But the early bylaws, how votes happen, those are still going to be all under the PAC bylaws. So just kind of keep those distinctions in mind. That gets a little confusing.
John Bell.
We have one more question online from Joe again. He's a frequent talker. Joe,
Yes,
just
thank you.
go ahead.
Thank you, John. My understanding is that the 72-hour rule, based on the Brown Act, would allow us for people to vote in accordance with a request to agree or not to agree prior to that date. And so I just wanted to confirm or at least ask that question. Thank you.
That's it.
What's that? I didn't understand what you said.
Perhaps we could pick this up next
Sure, yeah.
Wednesday when it's going to be more relevant.
Sounds like.
We are right now subject to the Brown Act, the PAC board, because we are in essence elected officials, because elected public officials, because we have that delegation agreement from the city. So this is why that is going to go away if we are under some other form of ownership. Joe's question was about, will we be subject to the Brown Act? The reason there are 4 people in this room right now who are PAC board members, but we are not subject to the Brown Act at this meeting is this is not a PAC board meeting. This is a workshop. And so the meeting next week is not technically a meeting, it is a workshop.
Thank you.
There you go.
Thank you for that. And
Yes,
basically what I'm saying
Okay, I
is,
think we're gonna